Hey guys, welcome to our financial future. This is a channel designed to build a community of investors so we can all reach our financial freedom. In this video, we're gonna go over the cash flow statement, all the numbers you need to know, and stick around till the end because you will want to know the most important number on the cash flow statement. So let's get into this. The cash flow statement is looked at as inflows and outflows of cash for operations and investing activities. There isn't too much to explain about the cash flow, just look at it as cash flowing in and cash flowing out for all the numbers represented on the lines that they are representing for. So now that we know that, let's head over to my computer and I'll give you a live demonstration of everything to look for.
We're going to use Enphase's recent filing of the cash flow statement in 2019. Up in the left hand corner we can see it's reported in millions. So when we come to the first line here, it says 161 million for net income, and whenever a number is positive, that means money is flowing into the business, and if it's negative, cash is flowing out of the business. The cash flow statement is divided into three sections, and the first section we're going to look at is cash flow from operations. This is the money that is generated from selling products from the business. So the first number here we're going to look at is net income, and all these numbers underneath are going to be added or subtracted from net income. So they had a net income of 161 million. The next number is depreciation and amortization, and this is the same thing as your car losing its value. The reason this isn't a cash expense is because no cash physically flowed out of the business. So they actually add that back into the business because no cash transaction was involved. Amortization applies to brands, logos, or anything that is intangible. Down here we have investment asset impairment charges, and this is when the market value of a company's asset decreases below its book value. Book value in this case represents a particular asset, and it's taking into account the depreciation. And when it comes to depreciation on the cash flow statement, it's not actually leaving the business because they already paid for it. So it's recorded as a positive number. I'm not going to read off all of the numbers because it's going to be different for every cash flow statement you're looking at. So I'm just going to describe things as we go along. And the next line is investment losses or gains. And this would be if they sold something and lost money on the sale or gained money on the sale of their investment. The next one down is deferred income tax. This means that the tax they are going to have to pay later, so that's why it is a negative number. If that tax was going to get returned back to them, it would be a positive number. The next one down is stock-based compensation, and this is a way a company rewards its employees. This allows the employees to buy stocks at a predetermined price. A company would do this because if you own stock in the company, you actually own a piece of the company. So this would actually make you want to do a better job and care about the company. Since they paid them out in stock and not in cash, that company saved their cash by doing that. So this is why it's recorded as a positive number. Since we're looking at a cash flow statement, they were able to save money by not paying their employees, so you can look at this as cash flowing into the business. Next, on to change in working capital. And if this number is negative, that means that they were able to pay off debt or found a way to decrease their liabilities. Cash has to flow out to do this. A positive number here would mean they took on new debt, so that means cash flowed into the company. And if you want to find what they are using that working capital for, you can go over to the 10K and go up into the find section in your browser, which is the little three dots on the right hand side, and a tab will come down and say find, and just type in working capital in there, and it will describe why that number is what it is. And here you can tell that it's only a 1. So in the annual report, it says that their working capital was neutral year over year. So you can see that they did not have to take on a lot of new debt compared to other years where they were paying off a lot of debt, when you see negative 23. So now down to accounts receivable. And this is products or services they've already given out but haven't received the money for. So treat that product as cash leaving the company. So the cash flow would be outflow. Let's move down to inventory now. So inventory either cost money to buy, which would be cash flowing out, or selling inventory would be cash flowing in, which would be a positive number. If the business sold more inventory than it bought, then this would be a positive number indicating cash flow into the company. And not selling more inventory than it bought, it would have cash flowing out of the company. The next line down, prepaid expenses, is a number on the cash flow statement that essentially is services they have paid for in advance before receiving them, making sense why it is a negative number, because that cash has flowed out of the business. The next one is accounts payable. This means that Enphase owes a company money but hasn't paid them yet, so the cash hasn't flowed out, making it a positive number because they still have that cash. Other working capital are items on the annual report. They are a lot smaller lines added together, and it would make this list huge if they have to add every single one of them. So I'm going to show you going over to the annual report for other non-cash items. And just to give you an example of the things you can find on the annual report. So same with other working capital, you can find this on the annual report. So I'm going to type up in the find bar cash flows from, and this will take you to the cash flow statement. And you can see here for non-interest expenses was $6,000. Financing fees on extinguishments of debt was $2,000, and fees paid for repurchasing of convertible notes due in 2023 was $6,000 as well. So if we add those together, that equals 14. So let's go back to the balance sheet or cash flow statement, and you can see here other non-cash items is 14. So that's why it's important to go over to the annual report and find these things. It'll be different for all the companies out there, so you'll have to be doing it for your specific company that you're looking at. Net cash provided by operations is essentially all of those numbers added up, letting us know if cash was flowing in or cash was flowing out. Now down to cash flows from investing activities. This is the second section of the 3 of the cash flow statement. Down to investments in property, plant, and equipment. So there was a $15 million cash flow that went out for land, machinery, and buildings. So under the acquisition section, you can see that there is a negative number, and that represents negative cash flow because they would have went out and bought a business. Now you can see here in 2016 that the number is positive, and I had to go into the annual report, and I had to go into the 2017 annual report because it reports the past financials. And what I found was that they had purchased a company that had gotten reevaluated and was worth more than what they had purchased it for. So they were able to receive, the money didn't come in as cash flow, but it was worth more than what they purchased. So it was recorded as a positive number of cash flow in. The next line down is purchase of intangible assets, and this can be things like a logo or a patent, something that isn't physical. So it would represent cash flow out as a negative number. So net cash used for investing is the sum of all of those lines added up, representing negative or positive cash flow. Now we're on to the third section of the cash flow statement, which is cash flows from financing activities. The first line is debt issued, which is represented as a positive number as cash flowing into the business because they went out and took debt, and that cash came and flowed in. The next line is debt repayment, and this is a negative number because it's cash flowing out and they would have paid off debt to do that. The next line down is common stock issued, and this would be represented as an inflow of cash because when a company issues new shares, the purpose of those shares is to raise capital, so therefore creating an inflow of cash. And other financing activities would be smaller lines that all add up into one, and this will be something that you have to go look for on the annual report. Net cash provided by financing activities is just the sum. So we're going to get into the last section of the bottom, and this is calculations that tell the story. And net change in cash is the amount a company cash balance increased or decreases during that accounting period. It is important to keep track that it doesn't run out. When you subtract cash at beginning of period from cash at the end of period, that's how you get net change in cash. Now down to where it says operating cash flow. This means what the company can generate from its normal operations to produce an inflow of cash. You can look at it like how much the business makes after an item is sold. Like if you bought a hammer for $3 and it cost the company $1 to make it and put it on the shelf, they made $2 from this. This is the biggest calculation on the cash flow sheet statement, as it lets us know the story from production to store and back into their pocket. A company might be able to generate huge profits or net income, but not produce actual cash flow. And this is a number that will expose dodgy accounting, because what we want to do is compare the cash flow to the net income to see how they are reacting towards each other. For example, a company could go out and sell a building, but that has nothing to do with the actual product they are selling. And if they make a profit off the sale of that building, then they can record that as profit. So this has nothing to do with business fundamentals. Capital expenditure, or short as CapEx, is what the company spends to maintain or improve buildings and vehicles, etc. And that is a outflow of cash to do that. Now down to free cash flow. And this is what is left over after CapEx and what the cash the company has produced throughout operations. Of course, we want all the cash numbers to be growing over time.
Guys, thank you so much for watching this video. If you found it useful, smash that like button. If you're new here and want to see more, hit subscribe. You'll get to see more of my videos when they come out. And I'll see you in the next one.